Sportswelder. I'm president of OTA and Compression, OTA Environmental and ChemArt. We provide environmental solutions from LDAR and environmental consulting and various equipment like vapor recovery units to the oil industry. Appreciate y'all being on for the 21st Oilfield Strong webinar. So we've had a good run of this and appreciate your support through this. We have a speaker that I've wanted to have on for quite some time because I heard a speech that he gave years ago when he was gainfully employed. But a big success in the oil industry, Steve Gray. So I'm happy to have him on. As you know, that he was one of the founders of RSP Permian, which then got sold to Concho. And then Concho, as you know, just merged with Conoco. So I think you really have an individual here that can walk us through the various issues associated with all the way from private equity all the way to the acquisitions and then the merger and consolidation that we've been seeing. The other thing that made me really want to have Steve on was that he gave a presentation, Steve, what was it, 5-6 years ago?
Yeah, it was four years ago, probably.
So you didn't think people were actually listening and remembering that, but I did. But it had to do with when you buy acreage, how much you pay for it, and then when do you drill it really determines your rate of return. And it kind of really spells out how you need to look at growing a company. And I'm sure that rolled into RSP and has rolled into Concho and Conoco's thinking in different regards. So, Steve, glad you're on and appreciate your time. If you could, maybe give a little bit of an overview of that presentation so they understand, they weren't lucky enough to hear it like I did, and then kind of roll it forward with some thoughts.
Sure, Grant. Hey, well, first, thanks for having me. As most of you probably know, when we merged RSP and Concho, I took a board seat on Concho's board, but other than that, I've been pretty semi-retired for the last couple of years. But back whenever I was the CEO at RSP Permian, I did a lot of industry presentations and met with a lot of investors. And during that time, what was going on was what I kind of call the land grab out in the Permian. Is whenever acreage values were continuing to inflate, and we actually had investors ask us, how in the world do you justify or anyone justify paying the kind of price for acreage that we're seeing particularly in the Permian, but in all of these shale plays. And so we actually put together a presentation that we thought was pretty honest to try to explain to investors the rationale for some of the prices that were being paid at the time. And so if you go back to that time, in 2014 was when oil prices really dropped. And so this was in 16 and 17 when oil was $50 or $60 a barrel, and RSP and some of the other public companies that we competed against were paying $25,000, $30,000 and $40,000 an acre for some of these leases. And so we kind of kept getting this question over and over. So we started by saying, if you look at what all the public companies were saying at the time, we were saying that our single well economics were really outstanding. People were talking about 50% or 100% rate of return wells, but investors were trying to understand, what are kind of the full cycle economics that implies, because it's obviously more than just a single well economics that matters. So we put together a presentation, and the gist of it was, if you bought 640 acres, for example, in the really sort of heart of the Midland Basin where RSP operated. So the example we used was in Midland County. And by this time, we had 4 or maybe 5 productive zones that we had actually drilled wells in and tested. So we had a couple of Wolfcamp zones, when we had a couple of Sprayberry zones. In some places you had decline. So we were looking at 4 or 5 zones. And our point was, okay, if you take 640 acres, you've probably got at least 15 wells that you can drill. And if these were $8 million wells, that's a huge investment. So if you paid $30,000 an acre for that lease, the leasehold bonus was only 15% of the total budget for this project. So whether you really paid $20,000 or $30,000 or $40,000 an acre, it slightly changes the rate of return of the project itself, but it's not a huge change, you know. And so the point is you can justify. Now, if you start out with single wells that make a 50% rate of return, and I think the example you're talking about, Grant, we were showing, you know, you can drill wells, you know, at $50 or $60 oil that we're going to make 50 or 60% rate of return. But when you fully loaded those with the facility cost and the acreage cost, then you were probably talking about a project that was a 20 or 30% rate of return project. And, you know, a corporate return of 20% is okay. You know, you have to think about that at the field level. Well, then you've got G&A costs and you've got interest costs. So, you know, for you to generate a 12 or 15% return for your shareholders, you better be doing projects that make 20% plus rate of return. And so the point was, even with those acreage costs, you know, our program would generate that 20 or 25% rate of return given those type of acreage costs if you were in a part of the basin where you had 4 or 5 zones that produced. I think where it got really sort of messy is if you got into the tier 3 parts of the basin where maybe you only had 1 or 2 zones that were going to work, then those kind of acreage costs don't make sense. And I think that's where some people miss the boat, if you want my personal opinion. But the other thing that we pointed out in that presentation was that what also matters is the timing. So if you sink all that upfront cost on bonus, and then you start your drilling program within a year or so, then that's how you kind of get to that return threshold that we were talking about. But I showed an example of if you sunk that bonus money and then you didn't start your drilling program for 5 or 6 years, then it showed how much the rate of return would be diminished. Not to mention the fact that most of the leases we were buying were 3-year leases. So if you bought a lease and didn't drill it for 5 years, you were probably releasing or extending it, so your bonus cost even went higher. And so when I look back at the kind of the whole acreage grab, and I think about, you know, what I hear from investors, that our industry hasn't generated returns in the last 10 years like it should have. You know, I see a lot of the value destruction because people bought, you know, big acreage blocks with a lot of, you know, high bonuses, and then the wells didn't get drilled. Then you had a change in oil prices in the atmosphere where people still have a lot of undrilled acreage that they paid big money for 3, 4, 5 years ago. And so I think that's where the value destruction comes in, is just the assumption that we were going to be able to drill all those wells in the ensuing 3 or 4 or 5 years. And because of market conditions, that's just not working out right.
Roll that forward for me, though, as far as, okay, then RSP got bought by Concho, so now that becomes Concho's issue that they have to drill that because they paid y'all a lot of money for the acreage and production, of course.
Yeah.
But now they have all that acreage, and that's an example. We could use several others, and then even fast forward to Conoco buying Concho. Now that's Conoco's issue. Now it's Pioneer's issue with Parsley. But how does that roll forward?
Well, it's not necessarily Conoco's problem because those costs are sunk, right? So, I mean, it is what it is now. What happens, and this is, I think, this is an issue that I argue with people about all the time, Grant, but when Concho bought RSP, as you said, they didn't spend one penny. We did a merger. So when you do a stock for stock merger, there wasn't a penny that changed hands that day. What's been interesting is the huge write-downs we're seeing in the industry right now because of merger accounting. You know, at the time we merged with Concho stock was trading at or near an all-time high. And so because of merger accounting, whenever they put our properties on their balance sheet, they had to basically mark them on their balance sheet at the value that they were on the day of the merger, right? So because of their high stock price, that implied a high price for our assets, and those assets went on Concho's books at a high price. Then the result of that is when prices broke down, all the impairment tests that hit companies like Concho, and so they had to write down those assets. But keep in mind, no dollars really ever changed hands. And I would argue that the value of Concho's properties and the value of RSP's properties both went down accordingly, or both went up accordingly.
Sure.
So, I mean, it's an accounting write down, but those costs are sunk now. And so going forward, I think that, you know, these companies that have taken these big impairments and taken these big write downs will be able to go develop those properties. And the result of it is you have a lower DD&A rate. So I think the returns are going to look pretty good on these wells as they drill and go forward. But clearly, you know, the companies like RSP that were playing in that boom were able to go to the public markets and raise equity. Every time we did an acquisition, we were able to finance it with equity. And that's what's changed, is people cannot now go back to the capital markets like we could 5 years ago and fund these acquisitions. So I think the strategy for Conoco is just like everyone else now, is a more modest drilling pace where they can generate true cash flow, live within their means, and return money to their shareholders. So I think the game has evolved from a very fast-paced, high-growth business where we were consuming outside capital to fund our growth to a more mature business now where investors expect people to probably moderate the growth and return more money to their investors in the form of either dividends or stock buybacks.
Bring up several things that I want to talk to you about on that. Now, the RSP Concho was a stock for stock. Obviously, there's quite a few that were cash.
Right.
And that's very
I think that's where a lot of the value destruction that people talk about has occurred. You know, I think some of those, you know, big acquisitions, clearly, you know, it's a function of the market, it's a function of oil prices. But yeah, the industry, no doubt, does not have a very good track record the last 9 or 10 years in returning value to shareholders.
And I would assume most of those folks that did it with cash / debt are now the ones that are being forced to merge or going out of business, going bankrupt, or meeting a kind of a different end.
That's right. That's exactly right.
So the other point that you had on the capital that you got to fund as it goes, let's talk about the effect of that. It should slow down drilling. What other, you know, what can we see with this kind of different capital market, not only for the Conocos or the Conchos of the world, but even down to the smaller guy, the smaller independent that's either private equity funded or kind of bank financed?
Well, I think it's interesting that if you, you know, if you really go back and look at our industry, since I've been in this industry for 35 years, the first 25 years, you know, we were short reserves and short production, and what we were really focused on was how much oil we were importing from parts of the world that weren't friendly to the United States. In the last 10 years, with the shale revolution, that's what's changed. Is we're not short oil reserves now. Everybody knows we have a lot of reserves in unconventional reservoirs, and you know, but we went through this growth period where, I mean, we were also excited because we were booking all these new reserves and drilling these big wells, and production was growing fast, and you know, it was kind of the race is on, and you know, the industry shot itself in the foot because we grew so fast and supplied the market so well that I think we affected the commodity price. And you know, and you can argue that it's not just the U.S., but it's a big part of the problem. And so I think investors, you know, institutional investors, made it loud and clear about 2 years ago that they really weren't interested in funding, you know, the hyper growth that we were seeing the last few years, and they wanted to see some returns of their capital. And so I think that they have forced public company behavior to change. And I think even the guys that were kind of the high growth companies 5 years ago, you're hearing them talk more about, you know, lower capital budgets, operating with less leverage, and returning capital to shareholders. So the companies that got in trouble and got too much leverage, I think right now you're going to see them, you know, drill at a more maintenance mode and pay down debt. And then once the debt is paid down to an appropriate level, you'll start seeing people return more money company to shareholders in the form of dividends. And I think the stronger companies, I think it's just going to look more like a mature industry where you're going to see moderate growth and you're going to see increasing dividends. And I think that's going to be the driver for the next several years. The other driver that everybody is talking about right now is the whole ESG movement. And I think that's the other big thing right now is there is a certain amount of capital that left this industry that's not coming back. And it's not coming back mainly for ESG reasons, but also part of the problem is the returns that this industry has generated in the last 8 or 10 years have been subpar. They've been a laggard. And so I think that's chased a lot of capital away from our industry. I think you can get some of those investors back by starting to show them a decent return. And in fact, I've had a couple of friends that are institutional investors that I've talked to in the last year or so, and I've said, I'm really worried about our industry and the lack of capital, and the capital that's gone away because of the ESG thing. And both of them told me, well, don't underestimate the fact that people still want and need to make money. And if you guys, can start generating decent returns for investors, we'll solve the ESG problems. Okay. And so I do think, I was talking to an investor just the other day, and I asked him about, their plans on the ESG front, whether they intended to just, quit investing in our space or not. And the answer was, I don't think they're going to quit, but they are certainly focused on ESG, and they are going to prefer companies that have good ESG standards over the ones that don't. And I think that's one of the differentiators between public companies going forward as far as being able to attract capital is not only are you going to have to be able to show good financial success, you're going to have to show good success on the ESG front as well. And that's not just environmental, it's also governance. The G in ESG is governance. And that's been an issue in our industry the last few years. I sit on a compensation committee at Range. And so I hear the feedback from investors, and they talk about the disconnect in our industry between executive pay and performance. And so I think that's just as big a part of our sort of ESG problem as the environmental side is. And so I think our industry has some work to do to kind of repair our reputation in those arenas. But I think if we would do that and start showing some decent returns to our investors, I think you'd see some of that capital come back.
It's interesting that you say the G is kind of on par with E. I think it's what I heard, because I've always thought it as a big capital E and a little s, little g. So
yeah,
I think the governance is becoming as big of an issue.
With the public company investors, yes, I think that is becoming a big issue, and it becomes bigger every year. And so I don't think that it's just the environmental side. I think it's both. Safety too. I mean, all of those things are going to be important. And the shareholder advisory services like ISS, they're starting to give companies scorecards on ESG just like they do on financial success. So I see that as one of the big changes in our industry in the last few years. And I think that.
How do you show us getting better as an industry on ESG or the E part or the ESG, the whole thing? Because, I look at public companies and they talk about, we're going to be better, we're going to reduce, and it's all very general. What do you have to do to convince the institutional folks and the public that you're really doing something about it?
Well, the two public boards that I've been on have spent a lot of time in the last couple of years compiling and publishing sustainability reports where they address all of those issues, and they talk about safety, they talk about emissions, they talk about greenhouse gases, and all of those things, that data is being collected, and these advisory services, shareholder advisory services like IS, actually compile that data, and they compare us to our peers. And so if you look at, emissions, for example, Range Resources, if you took all of our public peers in the United States, Range has one of the lowest emissions of any E&P company in the U.S. And so, we're proud of that record. And so that will get published in our corporate sustainability reports, and it'll be out there and it'll be available for shareholders to see. And I think that is going to become a bigger ever increasing part of how our business is judged.
And you talk range because you know it, but also range, isn't it more gas driven these days?
That's right. That's right.
And so it makes sense that gas and ESG have a better chance of benefiting each other.
That's probably true. There is definitely probably an advantage to being a gas company over an oil company when it comes to emissions. However, when you compare peers, we talk about all the Marcellus players, for example. Sure. Range stands out is one of the best. But yeah, it's a big issue, and I think that's part of the problem with the lack of capital coming to the industry right now. I don't think that's the whole problem. I think that it's a trickle down effect. So if you talk about, what's going to happen to the private equity markets, for example, I can remember in my days, Grant, of being a private equity company, almost every time we exited by selling ourselves to a public company, and so the old build it and sell it model that private equity used, we did it for 20 years. You amalgamated some properties, or you bought some leases and you drilled a few wells and you proved it up, and then you sold it. 9 times out of 10, you were selling to a small public company. And why were you selling to them? Because they needed growth, they needed reserves. The thing that I think that's really changed is, I'll pick on Concho because I know Concho. Why does Concho need to buy a private equity company that's got 50,000 acres in the Permian if Concho's already got 30 years of drilling inventory? And it gets back to what we started this conversation with, is if you pay for a bunch of locations and then you don't drill them for 20 years, you're just destroying value. And so it's really hard for a Concho to justify buying, any company, but especially a private equity company, and paying cash for it if those drilling prospects don't move to the very front of their inventory the day they buy them. And so the public companies that used to, buy us little private equity guys out, they're just kind of out of the market right now. So I think the challenge for private equity is the, kind of the exit side of the equation right now. And I know there's a lot of smart guys in private equity that are working on different alternatives to that equation. But the old model, the way we used to do it, is definitely not really working right now.
And again, that's using cash, because what we've seen with Diamondback, they just bought 2 companies, QEP and Guidon. So they're now, I guess, to get more acreage, or when prices are low, that's a good time to buy.
Sure, I think that's right. And I think to the extent that you can use stock, and keep your balance sheet straight and not take on too much debt, then people can do it. But I would argue that Diamondback, may had strategic reasons why those were bolt-ons that made sense, and the time was right, and the price was right. So there's always exceptions, but there are fewer of those now than there have been historically, as far as, viable candidates to sell a private equity company to when you're ready to exit. So I don't see that as an insurmountable challenge, but I see that sort of slowing down the funds flow a little bit. And I think that it's a headwind for private equity right now.
So given those points, say you lost everything and you had to go back and start all over again, how would you attack this, knowing, given what you just said about the private equity world, kind of the exits? If you were a young engineer or a small public company, kind of how do you navigate this?
I think the small public companies are just like the larger public companies, to the extent that you're competitive on a cost basis. You're going to have to start showing your investors how you're going to be able to pay them a competitive dividend that competes with other investments. So, the merger mania that's going on, a lot of that is driven by, I think people saying that consolidation is necessary. There's too many public companies, and I've heard both sides of that argument, because there are some small companies that are very efficient. And I think just to merge to get bigger isn't usually, the answer. And sometimes I hear analysts argue, that we've got to have consolidation. But I think it only makes sense in, if there's an underlying reason why that merger works. If you have complementary assets, for example, if one company is a much better operator and can lower costs as a result of the merger, there are compelling reasons. But just to get bigger in itself, it doesn't always mean lower cost. And so I think the smaller guys are just going to have to figure out how to, maybe live more within their means, be a little more conservative with the balance sheet, maybe a little bit slower growth, and show their investors how they're going to return capital. I think the private companies, I still think there's a place for private companies, and I still think that, that they'll be there as long as there's an industry, but the model might be a little bit different. In other words, be a growth company and then sell it and everybody gets paid on the exit. That may not be the model going forward. It may be that investors in private equity companies look for some kind of yield also, and so it's it may be more of a yield vehicle that you have to show them some returns over time instead of, you're not going to get any returns until the day we sell. And, that may not be as an easy way to run the business as it used to be.
Yeah, with the limited exit options, it does seem like, and we've seen this with quite a few companies where they're now kind of set up more as a production company, a yield generating company. And it seems like that would have to eventually roll back into the private equity and how they raise their money, because they're giving a lot different yield to that
right
returns than they would on selling in 3 years and flipping it out.
Yeah, I think it's been interesting in my career to watch private equity. It started with a couple of companies doing private equity in the oil and gas business, and I don't know how many there were at the peak, but there were probably dozens, that were doing it. I think you're going to see the universe of private equity companies that want to invest in the oil and gas space shrink. I don't know how many that's going to be, but I think you're already seeing that. The big private equity firms that have multi-strategies are getting away from the E&P or the oil space. And the guys that are strictly focused on oil and gas, I think you're seeing them start to pivot to, some of the other, sustainable energy or power or other, forms of the energy business to kind of expand their portfolios. And so, like I said, there's a lot of smart guys in private equity. They'll figure it out. There'll be ways for them to make money. But the old model will definitely not be the same.
No, I'd agree. So any sense on, you've kind of talked about the future of the industry and kind of future of really the Permian Basin and kind of what's going to happen with some of the consolidation. Any other prognosis?
I wish I had a crystal ball, Grant. If I did, I'd be a lot richer. But I guess it's interesting to me to see the cycles that we've lived through in our career, you and I both. And, last year was pretty ugly, with COVID. But I'm an eternal optimist, or I probably wouldn't be in this business. And so every time I see a down cycle, I just think about how it could look on the other side of the cycle. If public companies get the discipline that they claim they're going to get and quit trying to grow production, and you see consumption come back to more normal levels over, 2021, then eventually this period of underinvestment is going to catch up with us, right? And when it does, supply and demand are going to come back in balance, and then I think you'll see prices strengthen. And I think you'll have a healthy oil and gas industry again. I don't think we'll see the hyper growth that we saw, the last decade. But I think that there's a place in world economy for oil and gas for the rest of my lifetime. And I think there'll still be a healthy industry to support that. I mean, are we going to have to do things a little differently than we used to? Yes. But that's probably a good thing. And so I see reason to be rather optimistic. I may be a little more optimistic on gas, as you mentioned earlier, than I am on oil. But I think every time there's a bottom, a low in the cycle, everybody seems to get very negative. And then every time there's an up cycle, everybody gets euphoric, and I think that the cycle we're in right now reminds me of kind of the late 90s when all the majors were consolidating and selling assets. And there were a lot of small companies that were, you know, started and did well during that period of time. And I think you could see another cycle of, you know, the big guys that do the mergers, the Conoco Conchos, for example. You know, they're probably going to prune their portfolio and get rid of some properties. And when they do, there'll be opportunities for little guys, you know. So I'm optimistic that the industry has a way forward. And, you know, capital may not be as easy to get, but, you know, maybe that's a good thing. Maybe there was too much capital chasing the industry, you know. So I'm optimistic.
Things have a way of self-correcting and shift, and sometimes they overshift and then they come back. And hear
Always
people
do.
talk about $100 oil coming up. Who knows? And
Yeah.
and then you throw in about 30 minutes, we'll be getting a new president. So we'll see what happens with all of that, and keep our fingers crossed. Well,
Right.
Steve, let's leave it on that positive note. It's 30 minutes in, and we try to keep concise here. So, Steve, thanks for your time. Hopefully, all the attendees enjoyed it. We do have a YouTube channel. Just search OTA compression, and this presentation will be posted on that, as have all the previous webinars been posted there. So, Steve, thanks for your time, and enjoy being a former Concho board member.
All right. Thanks, Grant. Enjoyed it.